The same stock can get taxed twice in India, once before you sell it, and then again when you finally do. That is the part most software engineers miss with RSUs and ESOPs. They think the tax story starts when cash hits the bank, but often the first tax bill shows up much earlier. So let us slow this down and make it clean. There are only 4 moments you need to track: grant, vest, exercise, and sale. If you can place your stock on that timeline, the tax logic becomes much less scary. For ESOPs, the key salary tax moment is usually exercise. That is when you turn an option into an actual share. For RSUs, the key salary tax moment is usually vesting. You do not buy the share through a strike price there. You simply receive the share value as part of compensation. Then comes the second layer. If the share price moves after that first tax point and you later sell, that later difference becomes capital gains tax. So the mental model is simple. Salary tax first, capital gains tax later. 2 buckets, 2 different trigger points. Now let us pin down holding periods. The Income Tax Department ITR2 FAQ says listed shares become long-term after 12 months. The same FAQ says unlisted shares need more patience. They become long-term after 24 months. That single difference changes real money outcomes. A lot of startup ESOPs are unlisted, while many mature company RSUs are in listed stock, so you should never assume one holding rule covers both. Let us start with one clean ESOP example. Say you exercise 1,000 options at 100 Indian rupees when the fair market value is 400 Indian rupees. The spread is just the gap between those two numbers. In this case it is 300 Indian rupees per share, and that spread is what becomes your salary perquisite at exercise. So your ESOP perquisite value here is 3 Indian rupees lakh. That is not sale profit yet. That is compensation value being taxed because you received the share below fair market value. Assume you are already in the top slab and use an effective 31.2% including cess. Then the salary tax hit on that ESOP perquisite is 93,600 Indian rupees. Notice the real pain point now. Before you have sold a single share, you may already need 1 Indian rupee lakh to exercise and another 93,600 Indian rupees to handle the tax. That is why ESOPs can feel rich on paper and tight in cash. This chart shows what becomes taxable across the ESOP lifecycle. Nothing meaningful happens at grant or vest for this example. The salary piece appears at exercise, and the capital gains piece appears only at sale. Now let us move to the second tax layer. Suppose you hold those exercised ESOP shares for 30 months and later sell at 650 Indian rupees. Your sale value becomes 6.5 Indian rupees lakh, and your cost basis for capital gains is the earlier exercise time value of 4 Indian rupees lakh. That means your capital gain is 2.5 Indian rupees lakh. Because this example is an unlisted share sale held beyond 24 months, we are now in long-term capital gains territory. Using a post-July 2024 long-term rate assumption of 13% including cess for this example, the sale stage tax comes to 32,500 Indian rupees. Add everything up and you see the full ESOP picture. After exercise cost, salary tax, and later capital gains tax, the net profit left is Indian rupee for 23,900. Now switch to RSUs. Say 500 units vest at 800 Indian rupees. There is no strike price in this simple RSU example, so the full vested value is compensation. This is why RSUs feel simpler. No exercise decision, no separate strike price, and usually no big cash needed just to acquire the shares. But the salary tax still arrives when the units vest. So the salary income at vest is 4 Indian rupees lakh. That is the number that typically gets pulled into your salary tax calculation first. At the same top slab assumption of 31.2%, the salary tax cost here is Indian rupee 124,800. Still real money, but notice there is no separate exercise check on top of it. This chart shows the RSU lifecycle. The salary taxable value shows up at vest, and only the later movement from that vesting price to your sale price becomes capital gain. And now the sale leg for RSUs. Suppose these are listed shares in an India listed share style example. and you sell after 8 months at 950 Indian rupees. Then the sale value is 4.75 Indian rupees lakh, the cost basis is the vesting value of 4 Indian rupees lakh, and the short-term gain is 75,000 Indian rupees. The Income Tax Department's sale of shares guidance says specified listed equity short-term gains are taxed at 20% for transfers on or after 23 July 2024. Using 20.8% including cess in this example, the sale stage tax becomes 15,600 Indian rupees. So here is the practical difference between the two instruments. ESOPs usually ask you for a decision in cash at exercise. RSUs usually skip that step, but both still have the same broad two-tax structure. This is also why same-day sale is so common with RSUs. It collapses the second layer because there is little or no price movement after the first tax point. You stop carrying market risk just to find cash for tax. This bar chart shows the cash burden before sale in our two examples. The ESOP case needs Indian rupee 193,600 before sale, while the RSU case needs Indian rupee 124,800. That is a difference of 68,800 Indian rupees. Now let us talk about the famous startup exception, because this is where people hear half a rule and assume all ESOP tax is deferred. The Income Tax Department instructions say eligible startup ESOP tax can be deferred, and one of the key clocks is 48 months from the end of the relevant assessment year. But that does not mean you can ignore the tax forever. The same instructions say it becomes payable within 14 days of the earliest of 3 events, that 48-month point, sale of the shares, or leaving the employer. And the most important limit is this. That deferral rule is for eligible startup ESOP perquisite tax. It is not a blanket deferment for RSUs, and it is not a blanket deferment for every company calling itself a startup. So now you have the map. Let us turn it into a checklist you can actually use. Step 1. Identify the first tax trigger. For ESOPs ask, when am I exercising and what is the fair market value that day? For RSUs ask, when are the units vesting and what value is hitting my salary? Step 2. Identify your capital gains starting point. Whatever value already got taxed as salary usually becomes your cost basis for the later sale calculation. That stops you from mentally taxing the same value twice. Step 3. Match the holding period to the share type. Listed and unlisted shares do not get the same capital gains treatment. That one classification can change both your rate and your planning timeline. And here are the mistakes to avoid. Do not look only at grant value. Do not ignore tax before sale. Do not assume startup deferral applies to everyone. And do not mix up compensation income with capital gains. If this finally made RSUs and ESOPs feel less mysterious, subscribe to WealthCode. We break down India personal finance the way engineers actually use it, with numbers, edge cases, and clean mental models. Our next topic is how foreign tax credit works on US RSUs for Indian employees, because that is where the tax story gets even more interesting once global payroll enters the chat.